Understanding loan application fees. When navigating the world of loans, be it for a new car, a home, or another personal objective, borrowers often come across various charges and fees that accompany the borrowing process. One such fee is the loan application fee, a charge that can influence the overall cost of obtaining a loan. Understanding what a loan application fee entails, its potential implications, and ways to manage it can help borrowers make informed financial decisions. What is a loan application fee? A loan application fee is an upfront charge that lenders impose on prospective borrowers to cover the costs associated with processing and underwriting their loan applications. This fee is typically non-refundable, meaning if the borrower fails to secure the loan, they will not get the fee back. Its purpose is to compensate the lender for the efforts made in evaluating the borrower's creditworthiness and determining whether to approve the loan. Key highlights. Non-refundable nature. Most application fees are non-refundable, posing a risk for borrowers, particularly those with low or uncertain credit histories. Range of fees. Loan application fees vary significantly among lenders, anywhere from $0 to $500 or more, depending on the lender's policies and the type of loan requested. Criticism. Many observers regard application fees as garbage fees, which serve to inflate costs without providing additional value to the borrower. The importance of research. Before submitting a loan application, it is essential for borrowers to conduct thorough research not only on their credit scores but also on the standard approval requirements associated with the type of loan they are seeking. This preparation can help mitigate the risk of losing the application fee if their loan is not approved. Tips for reducing application fees. 1. Comparison shopping. Borrowers should compare loan offers from multiple lenders to find the best rates and fees. In some cases, lenders may waive the application fee as a competitive advantage. 2. Negotiation. Engaging in discussions with lenders about the fees associated with their loans can lead to reductions or complete waivers of application fees. 3. Utilizing online lenders. As evidenced by industry trends, online lenders typically charge lower application fees due to lower operational costs, as they rely heavily on automated systems for processing applications. Additional loan fees to consider. While loan application fees are one aspect of borrowing, there are several other charges that borrowers need to be aware of. Understanding these fees can provide a clearer picture of the total cost of a loan. Common types of loan fees include origination fee. This fee is charged by the lender for processing a new loan application and can be a percentage of the total loan amount. Appraisal fees, required for real estate loans. This fee covers the cost of assessing the value of the property being purchased. Administrative fees. These fees may cover various aspects of loan processing, including documentation and filing. Mortgage loans and fees. In the case of mortgage loans, closing costs can include a variety of fees that are bundled together. Lenders might charge closing points, a comprehensive fee calculated as a percentage of the principal loan amount, which commonly includes the loan application fee, origination fee, and other associated costs. Conclusion. Loan application fees play a significant role in the lending landscape, but they are not insurmountable costs. By understanding what these fees entail and actively researching lending options, borrowers can take steps to minimize their financial impact. Whether looking to finance a home or a vehicle, being informed and proactive in fee management can lead to substantial savings and a more favorable borrowing experience.